Singapore just rejected Goldman Sachs, JP Morgan, and Morgan Stanley simultaneously. Not one, not two. All three of the most powerful investment banks in the history of global finance declined in a single letter from the Monetary Authority of Singapore, issued at 9 a.m. on a Monday morning, citing what the authority described as insufficient alignment with Singapore's long-term financial architecture priorities. For the first time since Singapore established itself as Asia's premier financial hub in the 1980s, a process that was built, in no small part, on cultivating relationships with precisely these American institutions, the city-state had turned away Wall Street's three most prominent names, not in favor of European competitors, not in favor of Asian rivals, but in favor of a consortium of Singaporean and regional institutions that no one in New York had taken seriously 18 months ago. Warren Buffett called it the moment when a client became a competitor and no one in New York was paying attention. When you hear what the three banks had actually proposed, why Singapore's sovereign wealth fund had been quietly building the alternative infrastructure for 22 months, and what Warren Buffett says this reveals about the future geography of global capital, you will understand why this is not a banking contract dispute, but a structural repositioning of who controls the financial architecture of the world's fastest-growing economic region. Wall Street's relationship with Singapore was not merely commercial. It was foundational to the self-understanding of American financial institutions in Asia. From the 1990s onward, Singapore's regulatory sophistication, its rule of law environment, its English language legal system, and its strategic location made it the natural headquarters for American investment banks seeking regional presence across Southeast Asia, South Asia, and increasingly China. Goldman Sachs established its Asia-Pacific headquarters in the city-state in 1998. JP Morgan followed with a major expansion in 2003. Morgan Stanley's Asia operations were restructured around the Singapore hub in 2007. The three institutions together employed approximately 14,000 people in Singapore, managed an estimated $340 billion in assets connected to regional mandates, and had participated in advisory roles in virtually every significant sovereign and corporate transaction in the region for 3 decades. They were not guests. They were infrastructure. The contract that Singapore rejected was not a routine mandate. It was the advisory and structuring role for the regionalization of Singapore's financial infrastructure, a 5-year program that the Monetary Authority and GIC, Singapore's sovereign wealth fund, had publicly described as the most significant expansion of the city-state's financial services capacity since the 1990s. The program involved establishing Singapore as the primary clearing and settlement hub for ASEAN digital currency transactions, creating the regulatory and technical infrastructure for a regional green bond market, and developing the advisory framework for sovereign wealth fund cooperation across 6 ASEAN member states. The estimated fee revenue associated with the advisory mandates over 5 years was $1 billion. The strategic value, the relationships, the data, the institutional positioning was worth considerably more. Warren Buffett's observation about clients becoming competitors is not a metaphor. It is a precise description of what Singapore had done in the preceding 22 months. The origins of Singapore's decision traced to a document that was never intended to become public. In February 2023, a strategy paper prepared for the GIC Board of Directors by an internal research team was circulated to 11 people. The paper's title was Financial Architecture Independence, a Framework Assessment. Its core argument, presented over 83 pages, was that Singapore's financial ecosystem had become structurally dependent on Western financial institutions in ways that created 3 categories of risk: regulatory risk, as U.S. and European financial institutions increasingly operated under extraterritorial compliance frameworks that could affect their Singapore operations in ways outside Singapore's control; fee leakage risk, as the proportion of value generated by Singapore-originated transactions that was captured by Singaporean institutions rather than foreign intermediaries, had declined from 34% in 2010 to 21% in 2022. And strategic positioning risk, as the competitive advantages that Singapore had built in the 1990s, regulatory quality, legal reliability, geographic convenience, were being replicated by competing financial centers in ways that made American institutional presence more conditional and less structurally committed. The paper recommended a 24 to 36-month program of capability building in 4 specific areas: clearing and settlement infrastructure, structured finance origination, ESG and green finance standards development, and regional regulatory harmonization advisory capacity. It recommended that this capability building be conducted without public announcement, financed through GIC's existing investment programs in ways that would not appear in public disclosures as a coordinated strategy, and completed to operational readiness before any contract restructuring was announced publicly. The paper described this sequencing as essential to avoid defensive responses that would increase capability building costs. GIC's board approved the framework in March 2023. The program began in April. Over the following 22 months, 7 specific initiatives were completed. DBS Bank, Singapore's largest financial institution, established a structured finance origination group of 340 specialists recruited from regional institutions, European investment banks, and Singapore's own regulatory agencies. The Singapore Exchange accelerated its clearing infrastructure development, completing integration with ASEAN Central Depository Systems 18 months ahead of its previously stated schedule. The Monetary Authority of Singapore's FinTech office provided regulatory sandbox approvals for 12 new regional financial infrastructure providers, each addressing specific capability gaps that the February 2023 paper had identified. GIC co-invested in 4 of these providers, taking minority stakes that gave it both financial exposure and strategic relationship depth. None of this was secret in the conventional sense. Each initiative was individually announced. Each received coverage in financial trade publications. But no single initiative was described in terms that revealed the coordinated strategic logic connecting them. The analysts at Goldman Sachs, who track Southeast Asian financial market development, a team of 7 people based in Singapore and Hong Kong, published research in January 2025, noting increased regional financial market development activity in Singapore and describing the trend as consistent with broader ASEAN financial integration objectives. The research did not connect the specific initiatives to a coherent strategic program. It did not identify GIC's coordinating role. It did not flag the implication for Wall Street's institutional position in the region. Someone in Singapore read that Goldman research report. They found it satisfying. The RFP, the request for proposals for the financial architecture regionalization mandate, was issued by the Monetary Authority of Singapore on September 15th of the preceding year. It was sent to 17 institutions. 3 of the 17 were the American majors. 14 were Singaporean, regional Asian, and European institutions. The RFP's technical specifications, the specific capabilities required, the regulatory knowledge demanded, the regional relationship infrastructure that proposals needed to demonstrate, were written with a precision that reflected intimate knowledge of what each category of institution could and could not credibly offer. Someone who had spent 22 months building specific capabilities had written specifications that tested for exactly those capabilities. Proposals were submitted on November 30th. The American banks submitted proposals on the 29th. Goldman's proposal was 312 pages. JP Morgan's was 287 pages. Morgan Stanley's was 341 pages. The winning consortium's proposal was 189 pages. Shorter because it did not need to explain what it could do. It demonstrated with operational specificity what it had already done. The Monday morning rejection letter from the Monetary Authority was 6 paragraphs in length. It thanked each institution for its submission. It described the evaluation process. It noted that the selection had been made on the basis of demonstrated regional capability, alignment with Singapore's long-term financial architecture priorities, and depth of commitment to regional financial ecosystem development. It identified the winning consortium, DBS Bank, OCBC, the Singapore Exchange, and a regional advisory group called Archipelago Financial Partners that had been established 16 months earlier and whose founding team included 4 former senior officials from the Monetary Authority itself. The letter included one sentence that no amount of diplomatic phrasing could soften. The selected consortium had demonstrated a depth of regional commitment and institutional alignment that exceeded all other submissions. In New York, the first responses came from equity analysts rather than bank executives. Bank of America's financial services sector team issued a note at 7:15 a.m. New York time describing the rejection as a significant negative signal for Wall Street's Asia revenue trajectory. Wells Fargo's financial institutions analyst team published a note at 8:30 a.m. noting that the Singapore decision may signal broader regional reevaluation of American institutional roles in Asian financial architecture. Goldman Sachs issued no public statement. JP Morgan issued no public statement. Morgan Stanley issued no public statement. The silence was, in its own way, more informative than any statement would have been. Financial market reactions were specific. Goldman Sachs shares declined 1% on the day of the announcement. JP Morgan declined 4%. Morgan Stanley declined 8%. The declines were not primarily about the two. $1 billion in fee revenue, that figure across 5 years was manageable for institutions of this scale. The declines reflected analyst assessments of what the Singapore decision signaled about the future competitive landscape across the broader Asia-Pacific region. If Singapore had determined that it could build and operate sophisticated financial infrastructure without American institutional intermediaries, the question immediately became which other financial centers in Asia were conducting similar assessments. In Tokyo, the Financial Services Agency released a routine regulatory update at 11 a.m. In Mumbai, the Reserve Bank of India's deputy governor gave a previously scheduled speech on financial market development. In Jakarta, Bank Indonesia published its quarterly financial stability report. None of these events referenced Singapore directly. Each of them in the subsequent week was subject to renewed analytical attention as observers sought signs of similar strategic repositioning. The search was not entirely fruitless. The employees of Goldman Sachs, JP Morgan, and Morgan Stanley in Singapore, the 14,000 people whose daily work constituted the operational reality of American financial presence in the city-state, were not informed of the rejection through internal communication. They learned about it the same way the rest of the world did, through news alerts on their phones at 9 a.m. Monday morning. The uncertainty about what the rejection signaled for their own positions, their own mandates, their own career trajectories, that uncertainty was not resolved by Monday evening. It was not resolved by the following week. Warren Buffett's framework for analyzing the Singapore decision draws from what he has described as the competitive moat problem in professional services, the particular vulnerability of institutions that derive their competitive advantage from reputation, relationships, and perceived indispensability rather than from proprietary technology, regulatory licensing, or physical assets. In multiple contexts over the past 3 decades, Buffett has observed that professional services firms, consulting firms, law firms, investment banks face a category of competitive risk that is structurally different from the risks facing companies with tangible assets. Their moats are real, but they are maintained through continuous demonstration rather than through structural protection, A manufacturing company that owns the only plant capable of producing a specific component has a moat that competitors cannot circumvent without years of capital investment. An investment bank that advises governments and corporations on complex transactions has a moat built on perceived expertise, established relationships, and the reputational feedback loop in which past success generates future mandates. This moat is self-reinforcing when it is functioning, but it is also self-undermining when the perception of indispensability is disrupted. What Singapore did, in Buffett's analytical frame, was not simply reject a contract proposal. It demonstrated, publicly and irrevocably, that regional financial architecture of extraordinary sophistication could be designed, built, and operated without American institutional participation. Once demonstrated, that fact cannot be undemonstrated. The perception of indispensability, once disrupted, does not naturally restore itself. Buffett extended the analysis to what he called the client-to-competitor transition, the pattern in which institutional clients over time develop sufficient internal capability to internalize services previously purchased externally. He has described this as the most dangerous competitive threat for any service business because it comes from people who already understand exactly what you do and exactly what it costs. Singapore, over 22 months, had developed internal capability in every dimension that the rejected proposal would have addressed externally. DBS Bank understood clearing infrastructure because GIC had helped fund its development. Archipelago Financial Partners understood regional advisory because its founders had spent careers building Singapore's regulatory framework. The winning consortium had not built capability to win a contract. It had won a contract because it had built capability. His closing synthesis was characteristically concise. The most dangerous competitor is the customer who decided they didn't need you anymore because they already know where all the value is. So here's where we stand. Singapore rejected the three most powerful investment banks in the world, not as a negotiating tactic, not as a political statement, not as a regulatory rebuke, but as the natural conclusion of 22 months of deliberate capability construction that had made external institutional intermediation genuinely unnecessary. Warren Buffett explained the structural principle with characteristic clarity. Professional services moats are maintained through continuous demonstration of indispensability, and Singapore had just demonstrated at extraordinary scale that the indispensability was no longer real. Can Goldman Sachs, JP Morgan, and Morgan Stanley rebuild their institutional positioning in Southeast Asia's most strategically significant financial center without the infrastructure role that the regionalization mandate would have provided? Can the model of American investment banking as the default architecture of global capital markets survive the demonstration that sophisticated alternatives can be constructed within a 2-year timeline by a determined and well-resourced client? And the question that extends this moment from Singapore to every financial center in Asia, in the Gulf, in Africa, how many other governments are sitting in rooms right now reading their own versions of a February 2023 strategy paper, calculating exactly how long it would take to build the capability that would let them write their own Monday morning letter? Please hit the bell icon and subscribe my channel for daily updates.